We all know that businesses can go belly up, but did you know that some of the biggest financial institutions in the world have collapsed spectacularly, leaving countless customers and investors high and dry? The bizarre and scandalous stories behind these failures will leave you stunned. Get ready to learn the top 7 shocking facts about bank failures that most people don't know. From billion-dollar losses to fraudulent activities, we'll take you on a wild ride through the dark side of banking. While you may wonder, is my bank at risk? Number 1. There have been more than 16,000 bank failures in the United States since the 1800s. Did you know that since the 1800s there have been more than 16,000 bank failures in the United States? This number may seem staggering, but it is important to remember that bank failures are not uncommon, and they are a natural part of the business cycle. Bank failures can occur for various reasons, including mismanagement, fraud, and loan losses. Sometimes external factors, such as economic recessions or financial crisis, can also lead to bank failures. In the early days of the American banking system, bank failures were much more common than they are today, partly due to the lack of regulation and oversight, as well as the relatively undeveloped state of the American economy. In the 20th century, however, the banking system became more regulated, and measures were put in place to protect depositors in the event of bank failures. The creation of the Federal Deposit Insurance Corporation, or FDIC, in 1933 was a major milestone in this regard. We'll talk more about this later on in the video. Despite the measures put in place to protect depositors, bank failures still occur from time to time. The most recent wave of bank failures occurred during the financial crisis of 2008, and that leads us to the second shocking fact in this video. Number 2. The largest bank failure in U.S. history was the 2008 collapse of Washington Mutual, which had $307 billion in assets. Something horrible happened to the economy in 2008, and it was the largest bank failure in U.S. history. The 2008 collapse of Washington Mutual, with over $300 billion in assets. This was a significant event that had far-reaching consequences for the banking industry and the broader economy. Washington Mutual, also known as WAMU, was one of the largest savings and loan associations in the United States. It had a long history dating back to the early 1900s, and at its peak, it had over 2,200 branches with more than 43,000 employees. Long story short, WAMU was doing great. However, like many other financial institutions during the housing bubble of the early 2000s, WAMU took on significant risk by making loans to borrowers who were unlikely to be able to repay them, also known as subprime borrowers. As the housing market began to decline in 2007, the value of the mortgage-backed securities held by WAMU began to plummet. By September of 2008, the bank was in dire financial straits and was on the brink of collapse. On September 25, 2008, the FDIC seized WAMU and sold its assets to JP Morgan Chase for $1.9 billion. This was the largest bank failure in U.S. history, and it had a significant impact on the financial industry and the broader economy. The 2008 financial crisis and the collapse of WAMU were a wake-up call for the banking industry and regulators. Number 3. Bank failures can have significant economic consequences, including job losses and reduced access to credit. Number 3 on our list of facts about bank failures is that they can have significant economic consequences, including job losses and reduced access to credit. While this isn't exactly shocking, the extent of the damage might shock you. When a bank fails, it can have a ripple effect throughout the economy. Depositors may lose their savings, and businesses that rely on credit may find it harder to obtain financing. This can lead to job losses, as companies may need to lay off workers or cut back on hiring in response to a tighter credit environment. Bank failures can also have broader economic consequences. They can lead to a reduction in consumer confidence and spending, which in turn hurts businesses and slows economic growth. In addition, if a bank's failure is part of a broader financial crisis, it can exacerbate the crisis and lead to a downward spiral in the economy. For example, During the Great Depression of the 1930s, bank failures were a major contributor to the economic downturn. As banks failed and depositors lost their savings, consumers became more cautious and spending declined. This led to a reduction in demand for goods and services, which in turn led to lower profits and more job losses. When a bank fails, it's not just the depositors who are affected. The consequences can be far-reaching. Banks are key players in the lending market and provide crucial funding to businesses and individuals. Number 4. In 2020, there were only 3 bank failures in the United States, the lowest number since 2006. Did you know that in 2020, there were only 3 bank failures in the United States? Despite the economic challenges of 2020, it was a good year for banks in the United States, as that was the lowest number since 2006. This is a significant improvement compared to the peak of the financial crisis in 2009, when there were 140 bank failures. The decrease in bank failures in 2020 can be attributed to various factors, including the government's economic stimulus efforts and support for struggling industries, as well as increased regulation and supervision of banks after the financial crisis. Number 5. The most common causes of bank failures include mismanagement, fraud, and significant loan losses. Bank failures can be attributed to several factors, but the most common causes are mismanagement, fraud, and loan losses. Mismanagement can take various forms, including poor financial decision-making, inadequate risk management, and ineffective internal controls. Fraud can also occur in many ways, such as embezzlement, insider trading, and other forms of financial misconduct. Loan losses are often a result of poor lending practices, including relaxed underwriting standards, insufficient collateral, or loans to borrowers with weak credit histories. In many cases, banks that experience financial difficulties often suffer from a combination of these factors. The FDIC and other regulatory agencies work to identify banks that are at risk of failure and take corrective action to prevent failures and protect depositors. Number 6. Some bank failures are due to external factors, such as economic recessions or financial crisis. While the previously mentioned internal factors can lead to bank failures, external factors like economic recessions or financial crisis also play a role. During a recession, individuals and businesses may default on their loans, which can cause the bank to suffer losses. Additionally, if the bank has invested in risky assets or made bad loans, it may suffer losses during a financial crisis. In some cases, external factors can lead to a chain reaction of bank failures, or a contagion where the failure of one bank leads to the failure of others, causing a larger economic crisis. For example, during the 2008 financial crisis, the collapse of several large investment banks led to a contagion that resulted in the failure of many other banks and financial institutions. Understanding the impact of external factors on bank failures can help policymakers and regulators take steps to prevent or mitigate the effects of future financial crises. Number 7. Bank failures can have a ripple effect throughout the financial system, as other banks may become hesitant to lend money and consumers may withdraw their deposits. When a bank fails, it can cause a contagion that affects not only that bank's customers, but also other banks and the broader economy. When customers lose faith in one bank, they may start to worry about the safety of their deposits in other banks, causing them to withdraw their money or shift it to more stable financial institutions. This can lead to a liquidity crunch for other banks, making it difficult for them to lend money to businesses and individuals. As a result, the overall credit supply in the economy decreases, which can lead to a slowdown in economic activity and job losses. In extreme cases, a banking crisis can lead to a recession or even a depression. For these reasons, it's important for regulators to closely monitor banks and take steps to prevent failures whenever possible. So, do you feel more confident in your bank's stability now? Or maybe it's time to start considering alternative options. Whatever your decision may be, remember that keeping your finances safe should be a top priority. But wherever you ultimately decide to keep your cash, well, that's none of our business.